Hello sector watchers, welcome to the show. This is the 131st episode of Sector Spotlight for Tuesday the 14th of June, recording it on Monday the 13th. My name is Julius the Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. My contact details are on the screen in case you want to get in touch. Wow, what a week. And what a start of the week, because Monday's trading has already finished. Stocks on the move, bonds on the move, currencies on the move, everything's on the move. And there's quite a lot going on in the market. So for today, we're going to talk through asset allocation rotation. We're going to talk through current sector rotation. And then at the end of the show, I'm going to use RRGs for individual stocks as a gauge of breadth, a measure of breadth to get a handle on the S&P 500. Ladies and gentlemen, this is Sector Spotlight. Let's kick off with the rotations for asset classes. Right hand side we have the daily RRG, left hand side we have the weekly version. And if we start on the right hand side and just do a ranking on last week's performance, you'll see that there's a pretty much damage being done to a lot of asset classes. SPY was down 5%, high yields down 3.8%, real estate down 5.7%. That was the subject of last week's Sector Spotlight show. And VBINX, which is the 60-40 balanced index fund, was down 3.6%. So even a balanced portfolio, 60% in stocks, 40% in bonds, was down 3.6% over the last week. I think we can agree that it was not a good week for the financial markets. The only things that went up in price and by default are doing very well on a relative basis are commodities and the US dollar. So DJP and GSG both up 0.3 and 0.7%. And the US dollar gained 1.9%. And I think if I stick to this universe, I think that the US dollar chart at the moment is one of the most important charts to watch from a high level view, from an asset allocation view. If you look at the longer term picture, then obviously the commodity ETFs, DJP and GSG, are still leading the show. They went through pretty big corrective move last weeks, but you can see that the tails are now starting to bounce back up, and they're actually going kind of counter trend. And people who have listened to the show before and who have heard me talk before know that this is although it looks as if it's going counterclockwise, it is actually a very rapid clockwise move, and we can actually show that in the daily RRG, where you see the tails for GSG and DJP are rapidly rotating back up. But if we go back in time, you can see that, and let me highlight DJP, for example. It's a little bit easier. And you can see that we move back up and again there. So you see that the daily rotation is going through clockwise movements, although here also it's going very rapidly. This is like a corkscrew of daily rotations that eventually is leading to the weekly tails starting to move into that northeastern direction that we like so much. If we go to the US dollar, then you see that on the daily it's inside the lagging quadrant, it's picking up strength, and it's starting to move in sync with the tail that is in the leading quadrant on the weekly RRG. I'll go into those charts in a minute, and then the bigger picture is still for risk assets, so that's real estate and stocks, are now clearly moving lower, starting to come very close to crossing over into the lagging quadrant for SPY, and V and Q not much behind. And you see the cluster of fixed income related ETFs, corporate bonds, government bonds and high yield starting to pick up momentum and move to the right, starting to pick up relative strength as well. Let me quickly talk you through a few of the individual charts for asset classes. As I said, the US dollar, I think, is at a very important level. We have tested that major overhead resistance level in the dollar index, which was around 104, 105, and we went there a couple of weeks ago, dropped back, and we are now very rapidly trying to push back beyond that level. So if we stick to the dollar index, I think that the level you need to watch is 104, which is where we are right now. But ultimately, the high here that needs to be taken out is 105.06. Let's say 105. You know that I prefer to look at the euro-dollar chart, the most heavily traded currency pair in the world. And if we look at the daily chart, and I've been looking at this chart week in, week out here in the show because we can learn a lot from it. And last week we were discussing the fact that the euro-dollar bounced back from that low and was hitting on that trend line that was coming down, moving into that sideways move. And last week we were trading in that sideways move, and I told you it's either going above 108 or it's going below 106. And if it goes below 106, it means that this is this peak is in place, and we will very likely see a rapid decline. And that is now happening. So from this perspective, I think that a test of 103.50, that's the low that we saw in May, is now in the cards. If we look at the weekly version of that chart, it's a little bit quieter, but obviously it shows you the same picture. We set a new lower high, which fits perfectly inside this channel with lower highs and lower lows. So that rhythm is very much intact. And I've left my lines, my drawings as they were, but I'm not ruling out that next week or very soon we're going to adjust those lines to connect the 114.95, and then we get a little bit of a steeper trend channel going down. Time will tell. But the main message here is that the US dollar continues to gain and is coming at a pretty crucial level. When it breaks 103, parity is around the corner. Now, what does that mean for US stocks? SPY, the bounce is over. We put in a low at 380.54 a couple of weeks ago. We ran back to that previous breakout level that was perfectly tested as resistance. And now we are pushing below the previous low, below that 385 level. Beware, it's only Monday, so this is only Monday's price move, but the pattern and the rhythm of lower highs and lower lows is clearly visible. It's getting even more visible if you switch to the daily chart. This is daily bar chart for SPY, and these big gaps down, that's not good. I'm recording this. It's around 10, so it's market's already closed in the US. So we've got a very convincing close below 380.5, and two gaps that can qualify as runaway and breakaway gaps. Maybe this is not a runaway gap for sure, maybe not a breakaway gap, but we are still inside this area. But we're breaking below former support, which is very important. And here also on the daily RRG, we're continuing that rhythm of lower highs and lower lows. Means that the stock market remains weak. We quickly switch to bonds. IEF 10-year bonds in the US. I think I keep touting this. It's pretty crucial for the stock market because rates are rising very rapidly. Bonds are falling very rapidly. You could even say there's no place to hide. Stocks are dropping, bonds are dropping. So where do you need to go? Maybe commodities. That's an alternative. But if you're in the classic space, bonds are going down, stocks are going down. So be very, very careful. Maybe cash, the US dollar strengthening for a reason, could be a very good alternative for retail investors at the moment if it wasn't that already for quite some time. Here's the yield chart. Here is the yield curve chart. And this is the monthly. I created a monthly bar chart because the monthly closing chart that I usually use when I look at longer term didn't show the inversions. But here you can see that the 10 2-year spread is flipping around that zero level. That means that the yield curve, the 10-2 yield curve, is flipping back and forth between inversion and not inversion. And you know that an inverted yield curve is often seen as a precursor of a recession coming, and it's got a lot of effects on the stock market in general. So that's happening right now. Watch that zero level, watch that spread between the 10 and 2-year yields in US government bonds. And I'm going to use this occasion to point you to a tool which is not very often used on StockCharts, but that's the dynamic yield curve chart. You can look it up under the charts and tools, dynamic yield curve chart, and it allows you to actually see the yield curve. And this is the benchmark is the price of SPY, and here's the yield curve. So you see the yield that belongs to the various maturities, and you can actually move through time. I should actually make this a little bit bigger for you to see. You can actually move that red line. That's the point of the yield curve here, and with your arrow keys, you can actually move through time and see how that yield curve moves. At the moment, we are not inverted anymore, but we have been a few times in the last few weeks. You can actually see the levels here. You got to tick the box, show info, and you can see that 10-year yields are at 315 at the moment. 2-year yields are at 306. So it's only 0.09 difference, which is absolutely minimal. So keep an eye on that chart. Be careful with stocks, be careful with bonds, and keep an eye on the US dollar, because it's probably going to strengthen even further, which is usually a headwind, not very good for US stocks, which leaves commodities as pretty much the only alternative, at least on a relative basis. For sectors, I think the rotations are getting a little more erratic, I think is the right word. Until now, you know that I've been talking about defense leading, but also the weakness that we're currently going through basically since the start of the year. All started with the defensive sectors taking the lead while the market was still going higher. Then the market rolled over, still with defense in the lead. We had a little hiccup, and in the last down leg, it was not only defensive sectors leading, but it was also the offensive sectors really starting to underperform. Until then, they were kind of neutral, and then tech and discretionary really started to underperform. So we had basically the best of both worlds, or a perfect storm, or doesn't matter how you want to call it. But you know, defense leading, cyclicals, offensive, really starting to underperform, obviously dragging the S&P 500 lower. And if you look at the rotations of, let me start with the longer term picture, because that's where we've been focusing on. And we've been looking at these defensive sectors, and that's utilities, staples, and healthcare, being inside the leading quadrant and leading the market. They're still inside the leading quadrant, but as you can see, for a few weeks already, they started losing relative momentum. Utilities going almost vertically down, healthcare is going almost vertically down, and since last week, staples has now already also started to roll over. Now the good news is that they are still relatively strong on the RS ratio scale, so they're not losing too much of relative strength, which means that they are still in a relative uptrend, but the power of that uptrend, the relative momentum, is fading at the weekly time scale. Now when I look at the same three tails on the weekly, then I see staples coming back from lagging into improving. So went through a correction, not strange because we've seen this, and the question is how long it will remain in that setting. But staples on the daily is starting to pick up again. The same goes for for healthcare, which is inside lagging but starting to pick up, and utilities are inside weakening but starting to pick up. I don't know whether these rotations are strong enough to keep those tails on the right hand side and make them pick up that positive heading again, that positive RRG heading. On the cyclical side, things are kind of opposite. Discretionary is no doubt about it. Discretionary is powering further down into the lagging quadrant. And strongly underperforming the S&P 500. That's probably, together with communication services, I'll get to that in a minute, these are the two weakest sectors in the S&P 500. Technology and financials are in relative downtrends, that's why they're in the lagging quadrant, but they're picking up relative momentum. But just like the defensive sectors not losing too much on the RS ratio scale, technology and financials are not winning too much on the RS ratio scale. So the big picture remains the same, but they're going in counter-trend positions, and that's a situation where you need to be alert that you're not getting caught by a rapid rotation towards these more cyclical sectors. We're going to look at some charts in a minute, and I am not too worried about a rapid rotation, but it could happen. So I'm keeping it in the back of my mind. If I look at the tails for, say, tech financials, so here tech, you see it's inside leading, but it's already rolling over. And if that's going to continue lower, you see that they're kind of opposite to what's happening in defense. So this is a pretty important period in the rotation where we have to wait and see whether these short-term rotations are able to keep the weekly tails where they are on the side of the chart where they are. So tech rolling over on the daily, getting back into a negative RRG heading and pointing towards the lagging quadrant while weekly tail still going there. Then we have financials. Financials are going back into the lagging quadrant while the weekly is still going up. So gonna wait and see how this pans out. Honestly, I don't know. That it could go both ways. So very often you can sort of gauge whether one is leading the other, but right now I'm not so sure with the market flying everywhere. The daily definitely is not looking good, and on the weekly it's on the left hand side in lagging, so that's not good either, but it's picking up momentum. So I mean, you hear my doubt, but it's not a good doubt, let me put it like that. And discretionary, and obviously where's discretionary? All the way down here, you see that it went through a hiccup, but it doesn't even show on the weekly, and it's already rolling over, starting to move in sync with the weekly again. Let me very quickly browse through a number of the weekly charts for these sectors, because if we have some time left, I want to show you something cool using $1 and the individual members of the sectors. So here we go. So materials dropping out of the channel, not good. That's a negative sign. Relative strength still good, so this is still, from a relative point of view, one of the strongest sectors. From a price perspective, it's starting to roll over. This is pushing the S&P down. It's maybe relative, it's okay, but this is not good for the S&P 500. Here is communication services. We talked about it, that it was resting at a major support level, potentially looking for buying opportunities. Gone. We're breaking important support lower. Look at the room that there is to the downside. I think here around 50 is the first serious support level that I would find, which is $4 lower than where we are right now. Relative strength nowhere to be seen. Here is energy. That's probably the only sector that's still strong-ish. We've had this pretty big drop, but the trend is still there and it's looking relatively good. Here is financials. We're dropping, we're taking out the previous low and we're resting at an important support level. If that continues, it's dragging the S&P 500 lower. Here is industrials, dropping out of that range and now about to take out its previous low. Again, from a relative perspective, it may look good, but this price move is dragging the S&P 500 down. Here's technology. Again, breaking a support level. It's at least it's the previous low. Be careful, these are only today's observations, so there is four more days to go, which could negate this, but it's not a good start of the week, and with the current charts in the setting as they are with lower highs, lower lows, I'm not very confident that we're going to turn this around very, very soon. If you look at staples, already dropped out of its rising channel and it almost perfectly tested former support as resistance. We're now challenging to break below 69.3, which was the previous low. Again, from a relative perspective, looks good, but price dragging the S&P 500 down. Here is real estate. We talked about it last week. We're almost already hitting our target zone based on that head and shoulders pattern that I pointed out last week. Here is healthcare. Major break. If we close the week at these levels, we are completing a massive top in healthcare. Remind you, that is a defensive sector and it's putting in a massive high. From a relative point, it's still going higher. So, if these defensive sectors are breaking important support levels while relative strength is going up, what does it mean for the S&P 500? That's not very good. And here is consumer discretionary. As you can see, lower highs, lower lows. This relative strength is absolutely trashed. And we're pushing against support around 136. 130 is the next level. Lower highs, lower lows intact all over the place for this sector. Now, for the last few minutes of the show, I'm going to talk you through 11 RRGs, each of the individual members of each sector, comparing them to the $1 benchmark, which basically gives you a high-level overview of the general price direction for all the individual stocks inside the sector. You could call it breadth. It gives you the general direction in price trends for the individual members of that sector, and when you do it for all 11, you'll get a pretty good grasp of what's happening with the general price trend individually within the sectors within the S&P 500. Starting with communication services, you can see that the dominant position, the dominant move is inside the lagging quadrant. So these are downtrends, these are price downtrends for communication services stocks. That's a negative. These are dragging the price of the S&P 500 lower. Here is consumer discretionary, very clearly positioned on the left-hand side of the graph. Only a few outliers in the blue, but the dominant direction towards and inside the lagging quadrant, meaning downtrends, dragging the S&P 500 lower. Here is consumer staples. Relatively, pun intended, quite good. You can see that it's spread out, but this is $1. This is the price trend. And you can see that the bigger moves, the bigger tails are pointing to the lower left corner towards the lagging quadrant. So even this defensive strong sector is starting to roll over in terms of price trends. Here is energy. This is the only sector which has all its members still on the right-hand side of the graph, meaning that they're all still in uptrends, but you can see that a number, well, the majority is pointing lower and moving into the weakening quadrant. So these price trends are losing strength at the moment. This is financials. I think we can be very short about this. This is really pointing towards the lower quadrant. These are all in downtrends, so that's for the financial sector. Here is healthcare, quite similar. Still a few on the right-hand side for this defensive sector, but the majority, the dominant direction is towards the lagging quadrant. But there's still a little bit that's on the right-hand side, but it's already rolling over, which is a negative. Here we've got industrials. You can see the dominant position on the left-hand side, and pretty much everything is pointing towards a negative, is traveling at a negative RRG heading. Here is materials. That is quite okay. We know that the sector is quite okay, but you can see that the long tails, the long moves, the big moves are at the negative RRG heading. That means that these trends are rolling over. That's dragging the S&P 500 lower. Here we've got real estate. No words needed. We discussed that last week. Here is technology. Again, no words needed. Everything on the left-hand side, dominant direction, southwest, apart from IBM. And I'm going to take a look at that in an article later this week, because I think that's a very interesting situation there. And then finally, we've got utilities. Dominant on the right-hand side. They're still in uptrends, but they're rolling over. So this defensive sector is rolling over in terms of price trends as well. Most of these sectors are dragging the S&P 500 lower. And that wraps up Sector Spotlight for this week. Ladies and gentlemen, thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Looking forward to see you again next week, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.